Late on Friday, May 16, 2025, the ratings agency Moody's downgraded the U.S. credit rating from a AAA to a AA1. This was done just as the market closed going into the weekend, a strategy often used when bad news for the markets must be presented. This ratings downgrade is a further continuation of the trend we have all been watching towards a diminished role for the U.S. dollar in the global financial system. This move by Moody's will put further downward pressure on the value of the U.S. dollar, U.S. government debt, and add more financial stress to a global financial system currently being restructured. The trend away from U.S. dollar use globally originated from the Biden administration's decision back in 2022 when they removed Russia from the SWIFT system. The SWIFT system is the global payment network that facilitates payments internationally between countries. Russia's U.S. dollar reserves were frozen at the time, forcing Russia to look for alternatives for settling payments outside of the U.S. dollar system. This move by the U.S. also helped jumpstart the BRICS countries into developing their own payment system to avoid the potential problems that Russia faced. While this process is still developing, it has led to U.S. Treasury bonds being sold by many countries' central banks, reducing their exposure and risk to the U.S. dollar. These actions have put downward pressure on the U.S. dollar in recent years and may contribute to additional problems within the global financial markets. For example, using the Exter's pyramid diagram to illustrate, in the global financial system currently, U.S. dollars and U.S. Treasury securities are deemed very safe and are located just above gold in the upside-down pyramid of risk. The fact that the U.S. currency and its bonds are weakening puts tremendous pressure on all of the risk assets above it in the structure. In fact, U.S. bonds are often the primary asset for collateral throughout the credit system. A lower value on these bonds and currency means more collateral will ultimately be needed and required to keep the prices of the risk assets from dropping. More collateral will likely have to come from money printing by the U.S. Federal Reserve to support stability within the system. And in doing this, the extra money printing will likely be followed by U.S. interest rates rising higher, as bond buyers will demand higher yields to compensate for the greater inflation risk created by the money printing. The U.S. currently has $9 trillion of bonds maturing this year that will need to be rolled over. Furthermore, there is likely an additional $2 to $2.5 trillion of bonds needed to be issued to pay for the current budget deficit. Finding buyers for these bonds will not be an easy task, as the world is now moving away from the dollar, and many big U.S. dollar holders globally have been selling U.S. dollar bonds in recent years. Recently, there has been talk of changing the risk leverage ratio for banks, allowing them to purchase and hold more U.S. government bonds on their balance sheet. This change can help out short term, but one must be reminded that U.S. banks are still sitting on a large amount of U.S. government bonds with large loss positions. Back in 2020, U.S. banks bought over $1 trillion of government bonds, right after the COVID money printing spree began, when they were flooded with new deposit money. There was no way all this new deposit money could possibly have been lent out into the economy, and as a result, government bonds were bought en masse. This occurred at a time when rates were still at all-time lows. With the sharp and large rise in interest rates beginning in 2022, these bonds have dropped significantly in price and now represent huge unrealized losses on the bank's balance sheets. This situation makes the banks vulnerable and highly leveraged currently, especially at a time when the global financial system is changing structurally in a significant way. It is quite possible that we will see quantitative easing once again, where the U.S. Federal Reserve is forced to buy U.S. government bonds with printed money. This newly created money will be necessary to help absorb the large amount of maturing bonds and the newly issued bonds that will fund the deficit. This Federal Reserve buying will also help keep the yields from rising on existing bonds in the market, which is crucial to the U.S. economy. The last thing policymakers want now is to have rates rise sharply upward, as it could really hamper U.S. economic growth. Both the U.S. economy and the U.S. government need lower interest rates to keep the economy growing and keep the interest rate payments on U.S. debt from exploding higher. In conclusion, Moody's downgrade of the U.S. credit rating is further confirmation of the vulnerability the dollar faces as its role in the global economy is readjusted going forward. A weak U.S. dollar combined with dropping government bond prices increases the risk for all asset prices around the globe, no matter which currency they are in. This is inevitable in a U.S. dollar-based system, where the U.S. has been the world's reserve currency exclusively since 1944. And the transition away from this system will not be without pain. A 20% gold and 5% silver weighting in our permanent portfolio will help hedge this global transition for investors away from the U.S. dollar. Precious metals, specifically gold, is at the base of Exeter's pyramid and will likely continue to see capital flow into it as investors seek places to protect capital.